Hi, and welcome to the Sustainalytics podcast. Thanks for joining us today. In today's episode, we'll be chatting about the newest report in our 10-4 series, 10 for 2020, Creating Impact Through Thematic Investing. My name is Melissa Chase, and I'm a marketing manager here at Sustainalytics. And today I'm joined by Doug Morrow, Director of Portfolio Research, Martin Vezer, Manager of Thematic Research, and Megan Wallingford, Associate Director of Product Strategy and Development. Thank you all for joining today.
Thanks, Melissa.
Thanks, Melissa.
Thank you.
In today's episode, as I mentioned, we're chatting about 10 for 2020, Creating Impact Through Thematic Investing. And in this report, we're taking a look at 10 ESG-inspired investment themes for 2020. So Doug, can you give us a little bit of background on this year's report?
Sure, Melissa. So this is the sixth edition in our 10-4 series. It stretches all the way back to 2015. Sustainalytics has been putting this report series out every January for the last 6 years, and essentially it's our flagship thought leadership report. So we really use this report to analyze 10 highly topical themes or trends taking place in the market. We carried on that legacy this year by really drilling down on 10, I would characterize almost transformational changes taking place in different industries across the economy. And in one major innovation to this year's report, we assessed each of the investment themes against the SDGs, the Sustainable Development Goals, just recognizing the importance that the SDGs have come to play in the ESG world, in the RI world, both in terms of shaping the sustainability roadmaps of investors as well as corporates. So really, at the end of the day, what we tried to do in this report, which I think we did successfully, is providing insightful analysis on 10 topical ESG themes, and then assessing these themes against the SDGs to really indicate and show that investors can potentially create positive impact through investing in public equities.
Mm-hmm. So what did you find in this year's report?
Well, we, as in previous years, we produced 10 vignettes, if you will, or 10 individual stories across 10 different industries in the economy. But really, they can be grouped under 4 broad headings when you look at the underlying themes and trends. So we have 3 stories in a technology bucket. So obviously technology, the pervasiveness of technology, the incredibly rapid change of technology is having disruptive effects everywhere. So we look at some of these effects in the mining industry, in internet software and services, as well as in the machinery industry. So these are 3 technology-driven stories. We have 2 stories under this grouping called Health and Society. So really looking at methods of sustainable production, shifting consumer preferences, and things like that. We have a couple stories under ecosystem stewardship, as we call it. We're really assessing here the major pressures that companies in high impact industries are facing to minimize their both their environmental and social footprints. And then perhaps unsurprisingly, we have a basket of stories on climate change. So they're called, the bucket is called Mitigating Climate Change. And we're looking here at some pretty fascinating examples of companies and industries incorporating climate change considerations into their business planning and business strategy. And here we're looking at utilities, oil and gas, and the reinsurance segment of the insurance industry.
Great, Doug. Thanks for that overview. So you mentioned that in this year's report, we take a look at how these investment themes are mapped to the Sustainable Development Goals. Megan, can you talk about how the themes and the SDGs were mapped in a bit more detail, and how this mapping is useful for investors in understanding this report?
Certainly. Thanks, Melissa. So maybe just to start, for those listeners who might be less familiar with the SDGs, the Sustainable Development Goals, 2020 actually marks the global community's 5th year into this 15-year journey around the SDGs. And the SDGs are really this set of ambitious global goals that are intended to be sort of like a blueprint for peace and prosperity and achieving a sustainable future. Now, there are 17 different goals. They cover both environmental and social issues, and the issues range from addressing everything from climate change or climate action to no poverty to clean water and sanitation to sustainable cities. Now, what we've seen here at Sustainalytics over the last couple of years is really this continued increase in the level of interest from the market around the SDGs. And for the most part, investors that are interested in impact and sustainability have really adopted the SDGs as an authoritative framework and are seeking creative ways to really make and demonstrate substantial contribution to the goals. And we see this across asset classes and across investment strategies. So it really isn't the case with a certain type of investor or a certain type of strategies. It does run a wide range of investors and asset classes.
Great. And can you tell us a bit about how and why investors are incorporating the SDGs into their processes?
Yeah, so some investors take a broad approach. They're seeking to support all SDGs or as many as possible, while others are more focused. So they're choosing to concentrate on certain SDGs that align with their mission and values, or perhaps impact themes that they had already chosen to focus on. And in terms of that how and why, we really are seeing three general ways to use the framework. So one, investors are using it for goal setting, which I've already alluded to. Two, they're using it to actually guide portfolio construction or fund creation. And third, still others are using it for communication or reporting purposes. So with all of this sort of in mind, we wanted to put the SDGs front and center in our report this year in order to explore each theme through the lens of one or more SDGs and really unpack how that theme might actually be aligning to or contributing to the SDGs. And by doing this, we're really hoping to demonstrate how investors can contribute to the SDGs while pursuing opportunities in the equity market. I think the outcome is quite an interesting one. We've managed to hit on a wide range of SDGs. So you'll see we touch on, across our 10 themes, 9 different SDGs. And we explore connections and topics like how 5G technology can be leveraged in infrastructure upgrades to drive increased resource efficiency, which is a core target of SDG 9, industry, innovation, and infrastructure. Or, for example, how slow fashion, which is really about reimagining production and consumption processes in the apparel industry, how it's aligned to SDG 12, or many of the practices in slow fashion are very much aligned to SDG 12, which is about responsible consumption or production. And in a third and a final example, another interesting one would be the exploration of digitization and automation in mining, which is actually being leveraged to provide safer and healthier work environments for employees, which is ultimately aligned to and contributes to SDG 8, which is about decent work and economic growth. So I think at the end of the day, what we're hoping to encourage is to encourage investors really to explore and ultimately to adopt the SDG lens in their investment practices and in their decision making.
Great. Thanks for that, Megan. So, Doug and Martin, let's kick it back to you guys to chat a little bit more about the themes that are covered within the report. Doug, you mentioned that the report's broken up into 4 major buckets, so maybe we can cover each of those in the next part of this broadcast. The first bucket that we have here is scaling on big tech, so maybe you can give us a bit of background on what you guys found in this area.
Sure, I can start this one off. For the first story, we looked at 5G. This is the 5th generation of wireless technology. This technology promises great advances over the previous major wireless technology, 4G. So 5G promises theoretical peak speeds that go way above and beyond the previous technology. So it's about 10 times faster. We can hook up about 10 times more devices, and it will create a range of financial opportunities. The World Economic Forum estimates it will unlock about $13 trillion in global economic value by 2035. We look at this from an SDG lens in terms of the Sustainable Development Goal number 9, which is industry, innovation, and infrastructure. So this SDG is a call to action to build resilient infrastructure and promote inclusive, sustainable industrialization. And we think 5G can contribute to this goal as it improves the capacity to process, transmit, and collect data. But we also recognize that executing a 5G strategy can be challenging. It requires a robust technical talent and quality management for companies in this space. And so we run an analysis using our material ESG issue measures. So material ESG issues we refer to as MEIs for short. And the two MEIs that we use in this analysis are product governance and human capital. And once we look at range of companies that enter different points of the 5G value chain, we identify Cisco as relatively well positioned on these issues, and we feature it as an upside play on this particular theme. Doug covered the next two themes in this basket, so I'll pass it over to him now.
Yeah, thanks, Martin. So the second theme in this scaling big tech category is focused on the mining industry. And really, we're looking here at some of the transformative changes taking place in terms of technology, such as augmented reality, virtual reality, digital twinning, big data, blockchain, etc. And we show how not only do these technologies offer an obvious cost reduction benefit, but there's also an ESG value capture as well in terms of improved lost time injury rates and reduced fatalities. We analyze the industry and we show that mining companies that are implementing a lot of these technologies can potentially contribute to SDG 8, which is focused on decent work and economic growth. We conclude the piece by assessing a basket of 10 mining companies from our coverage universe on their overall level of unmanaged ESG risk, which is central to our model. And we also cross-reference by looking at mining companies that are piloting and implementing a lot of these technologies. And really, at the end of the day, the company that offers exposure to these technologies, but in a low ESG risk kind of way, is Anglo American. They're doing a lot of really interesting stuff, a lot of technologies being deployed under their future smart mining approach and initiative. So that's a quick summary of the mining piece. And then the final vignette under this technology heading looks at the growing rate of automation in the industrial sector and the machinery sub-industry in particular, looking at, for instance, the growing use of robots in industrial manufacturing facilities and things like that. There's a big concern here. On the one hand, these technologies offer, similar to the mining story, a cost reduction benefit, improved profitability, but there's also the obvious risk of workers in low-skilled jobs being displaced by robots. So we call attention to some of those risks. We make the case that companies in this industry that are implementing new technologies around automation, but also investing in programs to retrain and reskill workers can contribute to SDG 8. So on the one hand, implementing these technologies, but hedging against some of these structural displacement of workers, those risks. In the end, we assessed like a basket of companies in the industrial sector on our human capital MEI, which encapsulates a lot of these risks. And the company that performs best is called CNH Industrial. They are doing a lot of very interesting things and doing so in a way that minimizes their human capital risk. So they have a lot of human capital management programs set up and things like a dedicated chief human resources officer. So little flagstones like that. So yeah, that's a summary, Melissa, of the three stories under that first scaling big tech category.
Fantastic. Thanks for sharing that. Certainly sounds like big tech is a bit of a double-edged sword for a number of industries, and it gives investors a lot to think about. So moving on to the next bucket, health and society, what are some of the vignettes that you focused on under that bucket?
Yeah, we have two stories under the health and society category. The first one is on connected medical devices. We're looking at producers of connected medical devices as potential opportunities for investors who are looking to gain exposure to some areas of the market that are poised for growth, especially in the Internet of Things healthcare market. Several drivers that we cover in the report include the aging population globally, as well as other health and safety benefits offered by connected medical devices that could be used to address other medical concerns. So we focus in on this segment of the Internet of Things and healthcare to see how companies are working to improve good health and well-being. This is SDG 3. We also look at SDG 12, responsible consumption and production. And the reason that we're looking at that is that some of these device manufacturers are looking for ways to mitigate their environmental footprint when producing medical devices, but also in addressing after-use materials that come from them. So for our company analysis, we again use some of the MEIs in our toolkit. So one is product governance, and the other one is environmental and social impact of products. We also couple the MEI analysis with some controversy analysis. So company controversies are part of what go into our MEI assessment, but we pull these out because they're particularly telling to see how companies have been performing over time on issues related to the theme. And in this case, we're looking at several controversies related to cybersecurity and product safety. So once we look at a bunch of companies in the medical device manufacturing space, we find that Royal Philips really stands out as being on the lower end of the risk side on both of these MEIs compared to its peers, and has also managed to steer clear of some of those relevant high impact controversies. So now moving to the second story in this category of health and society, we take a look at this interesting trend in slow fashion. So many of our listeners are likely aware of the sustainability challenges facing the fast fashion industry. These concerns have been mounting since the infamous factory collapse in Bangladesh back in 2013, but just as recently as December 2019, fire factories in Delhi really renewed investor interest and scrutiny of some of the environmental and social concerns of the garment manufacturing process. So our story takes a look at this movement away from fast fashion and towards slow fashion in the apparel industry. Slow fashion is not just about producing less, but it's really about producing goods in a way that is socially and environmentally conscious by addressing issues such as living wages, safe working conditions, and water pollution in the manufacturing process. So we see an opportunity here for companies that are moving towards slow fashion to mitigate risk, but also capitalize on growing consumer demand related to sustainable products. And this is something that we see particularly among younger generations of consumers. The mapping onto the SDGs that we offer in this piece focuses on SDG 12, responsible consumption and production. And this SDG, it's a global call to action to reimagine consumption and production, both in terms of processes and patterns that go into manufacturing and trying to align those factors with a more sustainable future. When we do our company analysis, we look at a few of the MEIs in our research methodology. So one is human rights, and the other is environmental and social impact of products and services. We also take a look at controversies related to these MEIs, such as human rights and supply chain and labor relation controversies. And once we look at a set of companies, the one that stands out as being relatively lower risk is Kering. So this firm is at the forefront of sustainable production in apparel and luxury apparel, and it's rethinking the way the industry's approaching consumer demand for more sustainable products.
Thanks, Martin. Thanks for sharing those stories. So the next category that's covered in the report is ecosystem stewardship. What are the things investors should be thinking about in this area? What are we focused on in this bucket?
Well, the first theme in this bucket is looking at cleaner shipping. We find many risks really intensifying for the shipping industry this year. It's an industry that is responsible for a significant amount of greenhouse gases globally, and some projections are forecasting the overall share of global greenhouse gas emissions coming from shipping to rise significantly over the next 30 years. So shipping companies could become a target for regulators. In fact, they already are, as well as investors and other stakeholders looking to address concerns related to climate change. But there are other issues facing the shipping industry connected to emissions, effluents, and waste. these types of outputs are problematic, both from an environmental perspective as well as a human health perspective. One other major risk factor that we cover in this story has to do with the discharge of solid waste. This is a problem for marine organisms. Marine life is also facing risks related to vessel strikes and noise that comes from shipping. So, with all these environmental concerns in mind, we are thinking of framing potential contribution from the shipping industry to several SDGs, including SDG 12, that's responsible consumption and production. We've already covered that. SDG 13, that's focused on climate action, and SDG 14, which is about life below water. When it comes to SDG 12, shippers can maximize the energy efficiency of their current and new vessels and reduce waste by increasing the use of reused and recycled materials in their construction of ships and in their maintenance of ships. With respect to SDG 13, some leading companies in this space are working on research that focuses on investing in ways to scale up low carbon solutions such as onboard electric batteries and biofuels. And then finally, the SDG 14 that we look at, life below water, is something that we have been looking at in terms of the shipping industry when it comes to ensuring adherence to stringent environmental standards in the operation of ships, and the way that shipping companies adopt new technologies to protect marine ecosystems. And such technologies include treatment systems that are already available to ship owners, and these technologies can help reduce the amount of waste released into the oceans while they're at sea. So with this, we focused on 5 of the top 10 shippers in terms of the overall global fleet capacity. We use some of our MEIs, the Carbon Own Operations MEI, as well as emissions, effluents, and waste. We also consider the size of these companies because these larger shippers have greater potential influence on the industry overall. And when we assess 5 of these major shippers, Maersk stands out. It's the largest firm in our sample with a market cap of about $29 billion. And it's relatively well positioned on both of these MEIs compared to its peers. So we think it has the potential to have an outsized influence on the industry. It accounts for about 21% of global fleet capacity, which is significant. It's the largest shipper in that respect.
Thanks for that, Martin. So Doug, what else do we cover in the ecosystem stewardship category in the report?
In the second vignette under the ecosystem stewardship category, we took a look at biodiversity loss, which I would characterize as certainly an extremely important risk, but also one that I think is often overlooked by financial institutions around the world. We basically show that there's a small number of leading edge financial institutions. They tend to be not publicly traded, so development banks or small cooperative banks who are taking initial steps at factoring in biodiversity risk, biodiversity loss, etc., into their credit process, which is really, really interesting, and I think is likely eventually to be picked up by some of the larger publicly traded players. But watch this space and see. But certainly a fascinating set of developments taking place in the industry. We connect what's going on in the industry to SDG 15, life on land, and show how banks that are taking steps to integrate biodiversity risk into how they think about debt and debt financing could contribute to many of the targets that underpin this SDG. And in terms of the company analysis, as I mentioned before, we run many of the banks that we know are involved in and have exposure to this new type of risk assessment through our model. We assess them on one of the MEIs in our toolkit called ESG Integration Financials. And company that really floats to the top in this analysis is based in the Netherlands. They're called De Volksbank, and it's really one of their underlying brands, ASN Bank, that we characterize as a world leader when it comes to integrating biodiversity risk into how they think about credit decision making. So that's a summary of that piece.
Great. Thanks, Doug and Martin. So the final topic category that is covered in the report is focused on mitigating climate change. So what are the themes or stories that you guys covered under that category?
Yeah, I guess no surprise that we're looking at climate change. It's obviously one of the big issues in the RI world and has been for quite some time. We have three themes under this heading. The first is what we call, the story is called the game changer. So we're taking a specific look here at the battery storage market and battery storage deployments by utilities. I mean, battery storage obviously is in some respects all the rage these days, just in terms of the enabling role that it can play in fully unleashing the renewables phenomenon. Because I mean, obviously, solar and wind have been on a tear globally, but at the end of the day, there is the intermittency challenge, and batteries are ideally positioned to help get over this challenge. So that's how we characterize it in the story. We make the case that utilities that are investing in battery storage can potentially contribute to SDG 7, which is focused on affordable and clean energy. When it comes to the company analysis, we look at utilities that are taking early steps in this direction, and we assess them on their overall level of unmanaged ESG risk. And the company that really performs well in this assessment is Acciona. Not only do they have relatively low ESG risk compared to their peers, but they're also a world leader when it comes to announced and installed projects for battery storage. So lots for investors to be excited about there. And the second theme is the title of the story is big transitions from big oil. Clearly oil and gas companies face long-term structural headwinds in an economy that is looking to move to decarbonize. And we basically investigate the extent to which the big oil majors are looking to diversify their revenue streams and invest in low carbon technologies and projects. When it comes to the SDG connection, we look at SDG 13, but we're very careful here. And this piece is perhaps unique in the sense that the industry, I mean, let's face it, it is fundamentally misaligned with the achievement of the SDGs in terms of its core product. But we make the case that companies that are investing at the margin in low carbon alternatives or are taking steps to incorporate climate change risk into how they think about the world in terms of project planning, et cetera, could contribute to to this SDG at the margin. So it's a bit of a complicated one.
It certainly sounds complicated.
In terms of our company analysis, as I said, we concentrate here on the big oil majors, and we score them on our carbon products and services MEI, so one of the MEIs in our toolkit. And at the end, the company we profile is Total. They're doing, I would argue, and our analysts would argue, doing a relatively good job when it comes to diversifying their revenue streams. They're engaged in multiple alternative energy technologies, including renewables, hydrogen, etc. So that's a bit of a summary there. And the final story is focused on the reinsurance segment of the broader insurance industry. Obviously, climate change is front and center for insurers and reinsurers and has been for a long time. And we just show the response that the industry is taking to the growing threat of climate risk. I think there's a lot of evidence in the market that models are struggling to keep pace with the degree of change in terms of natural loss events and climate events and things like that. Many reinsurers are obviously readjusting premiums on P&C policies, looking to improve the accuracy of their climate models, through the use of AI and other technologies. And also, we talk about how a growing number of reinsurers are exploring and indeed entering both the cat bond market, which is relatively well established, but also the resilience bond market, which is much less established, but lots of interesting products there. In terms of SDGs, we argue that reinsurers that are implementing these practices could potentially contribute to SDG 11, which is focused on sustainable cities and communities. And in terms of our company analysis, we look at all the usual suspects that listeners might expect, Swiss Re, Munich Re, and others. And we summarize some of the interesting steps these companies are taking. But at the end of the day, the company we profile is Swiss Re. Lots of interesting developments here, including thinking about and implementing new types of risk transfer products. And more broadly, they were among the first reinsurers to really think about how ESG factors can affect the the performance of their investment portfolio. So that's a summary there.
Terrific. Thank you so much, Martin and Doug and Megan, for providing this wealth of information for our listeners about the 10 for 2020 report and some of the themes and areas that we think investors should be focused on or will be focused on in the year to come. If you're interested in downloading a copy of 10 for 2020, please visit our website at www.sustainalytics.com. Thanks everyone for listening, and thank you again, Doug, Megan, and Martin, for joining us today.
Thanks,
Melissa.
Melissa. Thanks everyone for listening.